Welcome to Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and again on Saturday morning at 9 a.m. on KATX and KWBY as Angela Robinson joins Stace Gaddy to share important financial information to help you live life on purpose. Insurance, investments, estate and tax planning, and much more. All covered now on Life Planning 101.
Good morning again, every single one of you. Welcome into a brand new edition of Life Planning 101. As the nice announcer man said, I'm Stace Gaddy. Our expert and guest, as always, Angela Robinson from Kennedy Financial Services right here in Eastland. Good morning, ma'am.
Good morning, Stace. Happy to be on the show this morning. And I know January was a challenging month in the markets. We actually had two CFAs come on our show. And for those of you who don't know what a CFA is, it's a certified financial analyst. And it's what these guys that manage these big funds on Wall Street actually have as a designation. It's the elite of the elite in the industry. And we were joined by two of them over the past month to kind of give us market updates and what's going on. And because of all the turmoil, we decided to go ahead and dedicate a whole show to the markets. And I think it's really important to, sometimes just take a step back from everything that's going on, the craziness, the emotions, and really figure out, okay, what needs to be happening in my plan? What do I need to be doing? I actually was visiting with a gentleman this weekend, and he does rent houses. He's always bought and sold them. It's what his dad did, and it's how they've made their money, and there's absolutely nothing wrong with that. It's a great way for people to make money if you've got the wherewithal, the time, the know-how, and of course you're good at keeping your emotions in check, right? Right. So there's a lot of benefit to that. And he said, I don't invest in the stock market. I have never had good luck investing in the stock market. Those were his words. And it just got me to thinking, for the show, because, I have heard in my profession, of course, you do hear this because people just talk to you and inevitably they just start talking to you about the markets. And
I bet that's true everywhere you go.
Yeah, that's right. And, I do hear that a lot about luck when it comes to the markets. And I think it's important to really discuss that. And the reason I say that is it can be a gamble. You can gamble in the markets, but it doesn't have to be a gamble. I want to go back to thinking, just like on those rent houses we were talking about, did he take risk by buying those rent houses?
Sure.
Yeah. Did he take risk by putting his own money, time, effort into those rent houses?
Yes.
Yes. So
putting his faith in other people.
That's right. So in order to gain that reward, he had to take some risk. Well, the markets are no different. No matter what level you invest at, you have to take risk to gain some type of reward. And a lot of people are thinking, well, what is that risk? What really is market risk? And, we talked about, I think it was a couple months ago, we had a show on, the market boils down to basically two things. You either are an owner or a loaner in the market. And you either own a piece of a company or you loan money to a piece of a company. So that determines your risk. And it's also determined on the company itself. How solid is that company? And at the end of the day, I want to go back to really, really looking at history in today's show. I'm actually going to give you 81 reasons why not to invest in the stock market today.
Okay.
Believe it or not. And then we're going to talk about the one reason that you should consider it.
We're going to need some more time.
Yes. Yes. And I do want to let you know, we've got, of course, this article for today. It's posted on our websites, katxradio.com and kwbradio.com. You can go on there and look at this because it is very powerful. And I think sometimes, again, we just get caught up in the emotion of what's going on because, would you agree with me, Stace? Do you think our world is in turmoil today?
Very much so.
I agree.
Without question.
I totally agree. And I bet that's the exact same thing that they were actually saying in 1951 when the government came out and said, we now have an excess profits tax. What about the Korean War that was going on at that same time, right, in 1950? I think the world felt like it was in turmoil. So even as bad as we think we are in of a position today, we have to oftentimes gain the bigger perspective and look at history because history is a great way great way. It doesn't always repeat itself, but it's a great way to actually learn about what we should and shouldn't do. Would you agree with that?
Yeah, it often repeats itself.
It often repeats itself. Yeah. In fact, there's
different forms.
Yeah. I tell you what, if you get into the political scene at all, I mean, there's some amazing emails going around about how capitalism reverts back to, the beginning of time where you have socialism, communism, all these things, and why. And that's so interesting to see that, because it's just what you said. History has a tendency to repeat itself. But that's what we're going to do in the show today. We're actually going to go back and look at history. But before we do that, I want to mention something that happened last year. Last year, would you say that it was a volatile time in the market?
Yes.
Absolutely. We were up and down. We ended up the year just slightly negative. And here's the interesting thing. The only reason we were slightly negative is there was only 4 stocks that were really outperformers in the market. And it reminds us a little bit of 1999, believe it or not.
Okay.
Yeah. So these 4 stocks are known as FANG. If you actually look it up, you'll see it. Facebook, Amazon, Netflix, and Google.
Okay.
FANG. And their return in the S&P 500 last year, those 4 stocks accounted for almost 4% of the return in the S&P 500.
Wow.
4 stocks
Just
out of 500.
4.
That's right. And the reason I say it reminds us of 1999 is there's a thing called herd mentality. Well, if everybody's doing it, I should be safe to be able to do that.
Well, that's the philosophy.
That's the philosophy. Our mind gets wrapped around
I think
that.
it gets us in big trouble.
Yes, it does. And I want to give you an example of this. Amazon, right now, okay, they are so overinflated that it would take 10 years of Amazon making a 30% return with the stock growing at 0 for them to get back to normal, what we call price to earnings ratio, and make it where it's not overpriced for you to buy.
Where it's real.
Yeah. Isn't that crazy?
Wow, yes.
Okay. So just want to talk about that because, again, history repeating itself. I think it's really important for us to point out these factors. When we come back, we're going to get a little bit more in depth on that.
More Life Planning 101 right after these messages from our sponsors. Welcome back in, everyone, to Life Planning 101, our middle segment. Once again, here is Angela Robinson.
Yes, so we were talking about FANG, what's actually happened in the markets this last year, and it's very interesting because we mentioned about how it would actually take Amazon 10 years of a 30% return at 0 stock growth to get back to what we call a price to earnings ratio of 100. And here's a rule of thumb on that. I know that sounds like a lot of Greek, okay? So a rule of thumb is that your earnings growth, your PE should be 1.5 to 2 times earnings growth. Okay, what is earnings? Earnings is simply revenue minus expenses. That's your net earnings. So when you go price something, let's say your earnings is, at the end of the day, $1,000, and you have 100 shareholders. You divide that $1,000 by 100 shareholders. That gives you $10 per share. So your earnings should be 10 to 20. And right now, if you look at Amazon, theirs is 900.
What?
Yeah, what is about right? Okay, so yeah, so that's crazy. It goes back to that herd mentality. So I want to forewarn you of that because I think there are a lot of stocks, and I mean a lot. Now I say a lot. The most popular stocks you could be thinking about could be very overpriced in today's market, and we could be looking at what we saw back in 1999. Do you remember 1999? We had the Y2K scare, and everybody went to buy technology. And then what happened in 2000 when Y2K didn't happen? When we didn't lose everything didn't shut down overnight. Yeah, the market crashed. The technology market crashed, right?
I have a bomb sound effect. I'll spare you.
We've got, we need to make sure that we're looking at quality stocks, value stocks in today's market. And we're going to talk a little bit about that. But let's go back to these 81 reasons why not to invest in the stock market. And I want to go through history, and I want to kind of bring up some things that may resonate with some feelings that you have about our markets today and our economy today. And if we go back and on this list, if you pull it up online, you actually see we have a reason for every year from 1934 to 2016 not to invest in the stock market. Every year. In 1934, it was the Great Depression. Mm-hmm. Okay, 1941, it was Pearl Harbor. Mm-hmm. Our country got bombed. Does that sound familiar? 1951, like I mentioned, that excess profits tax. Taxes were getting high. Can you believe in our country we used to pay a 50% tax rate?
No.
Yeah, we did. And what are we so worried about today, right? Increasing taxes.
Exactly.
Okay.
Not getting back there.
That's right. Not getting back there. But it doesn't mean the world's coming to an end. And oftentimes that's where we get the feeling, right? Oh, it's going to be all over. There's no way to turn this large ship around. Well, yeah, as the U.S., we do drive the Titanic. But if we do some planning in advance, there might be ways to avoid the iceberg, right?
So we have a big engine and a big rudder, too.
That's right. That's exactly right. So 1954, get this. It was a market high that year. The Dow topped 300.
300.
300.
Wow.
Isn't that impressive? 1963, our president, Kennedy, was assassinated. 1966, the Vietnam War escalated that year. Is that hitting familiarity about some things going on in our world
ISIS,
today?
Vietnam,
right?
Parallels.
What about 1969? The market fell and money tightened. What about 1972? The largest U.S. trade deficit ever to date. Our country's debt was higher than it ever was before.
Okay.
Didn't we just go through that a couple years ago?
Yeah, debt ceiling every single year.
Yeah, okay. So hitting a little bit. What about the year following that? The energy crisis in 1973. Is that sounding familiar? Mm-hmm. Okay. 1974, the steepest market drop in 4 decades happened in 1974. 1977, the market continued to slump. We ended up in a recession for several years. Interest rates rise in 1978. Ooh, sound recently familiar, right? We just had a raise in interest rates back in December, and then what did the market do? It went crazy. Mm-hmm. Okay. 1979, the oil prices skyrocketed. So we had this energy crisis in 73. The oil prices skyrocketed in 79. 1981, steep recession begins. 1982, worst recession in 40 years. 1984, record federal deficits again. 1986, another Dow high. You ready for this one? Yes. 2000.
Whoa.
You remember?
2000.
We were all worried it was going to go back to 2000 and 2009. I remember those days. You know, when it hit the 6,000s, it was going to 2.
Yeah.
It was going to 2. And that was a record high in 86. 1987, we had what was called Black Monday. In one day, the Dow Jones Industrial Average dropped 22.61%, and if you would have bailed out of the market that day, you would have never regained your losses.
It still hasn't come up 22.6%.
No,
there.
it did. It did within the next week.
Oh.
It rebounded within the next week.
Oh.
So by the end of the year, the market was positive double digits.
And you would have been out all of that.
You would have been out all that. Isn't that crazy? And that sounded familiar. Remember that little crash we had, the flash crash a couple years ago? Uh-huh. Yeah. 1989. It's almost the same thing happened, the October mini crash. And then we went into this huge bull market after that for almost a decade. Or for over a decade. I'm sorry, not almost a decade, over a decade. We hit it till 2000, 2001, 2002. The healthcare reform in 1993, ringing any bells? 1995, we hit another high. 5,000.
Wow.
Yep.
That's not very long ago either.
No. 96, 6,000. 98, we had the Asian flu crisis. 99, we talked about the Y2K scare. 2001, we all know what happened in 2001.
Which, by the way, exactly 60 years from Pearl Harbor, which you mentioned.
Yes, that's right.
Not the same date, but year-wise, 41 to 2001.
That's right.
Interesting.
2008, the global financial crisis begins. 2009, the U.S. unemployment rates exceeded 10% in our country. It's still debatable if they're there or not today, right?
Right.
Depends on who you ask or what surveying company you ask.
Labor force participation.
Right.
Right.
Yeah. 2011, we had the European pigs. Our friends over there in Europe that were all about to fell on their debt. 2012, we fell off our own U.S. fiscal cliff again. Remember our government shutdown that happened in the fall? Everything froze up and everybody was scared to death. 2014, and believe this, I was actually writing this. I thought, oh my gosh, that was 2 years ago. It was the Ebola outbreak. It felt like that was yesterday. That was 2 years ago. And then, so what about today? We've got the Paris attacks, these mass shootings. We've got market volatility, oil crisis, ISIS, election turmoil. What is it going to be this year? So when we're sitting here 20 years from today looking back, what's going to be on that list, right?
Right.
So those are a lot of reasons not to invest in the stock market.
Exactly 81.
Exactly 81. That's right. That's right. So when we come back, I'm going to give you the reasons you should. And we're going to talk about how to do it effectively and not so-called gamble and just have good luck.
Wow, fantastic. Let me give you a gigantic round of applause for that. What a beautiful historical outline of the market. That was fantastic. Angela Robinson, everybody. I'm Stace Gaddy. We're going to take a quick break. Come right back with more Life Planning 101. Welcome back into Life Planning 101. Our final segment this morning, Angela Robinson, our guest and expert from Kennedy Financial Services here in Eastland. I'm Stace Gaddy. Listen, folks, if you missed the fantastic historical overview of the market just now in our last segment, be sure and go on either one of our websites, katxradio.com or kwbyradio.com. You can hear the program in its entirety. You won't want to miss that part. 81 reasons why not to invest in the market. We've just heard those, but now, Angela, maybe some reasons we should.
That's right. We just talked about history, and we talked about what's going on in the markets today. There's a lot of volatility, a lot of concern. There's a lot of concern in our world. We are concerned. I'm a concerned citizen of the United States of America. I'm concerned for myself. I'm concerned for my future. I'm concerned for my children's future, specifically my grandchildren's future. I think it's so important for us to, really look at what we can do to make a difference in each of our households. So we start being that change we want to see in the world. But we went over these 81 reasons not to invest in the stock market, and a lot of the same concerns that we have today we just heard about that happened before. And although we can't say that everything that's happened before will happen again, I can tell you this. If you would have invested $10,000 back in January 1st of 1934, do you know what that would be worth today if it were in the S&P 500 the whole time and you didn't pull it out? $42,257,300.
Oh.
All that crises we just talked about.
If you just don't panic.
Okay. Now, most of us were not living in 1934. And if we were living in 1934, we probably didn't have $10,000 to invest in the stock market. So I decided to go back and kind of make this a little bit more realistic and see what would have happened if a 65-year-old today, or in 2015, at the end of 2015, went back to when they were 30 years old. That's more doable. And they would have invested $10,000 on January 1st of 1985. What would it be worth today? $513,600.
Wow.
Yeah. I'd say that's one
For doing nothing.
Yeah, I'd say that's one very, very good reason to be an investor. Wouldn't you?
Yes, but
Yeah.
you need expert advice.
That's right. So we know we can't buy the S&P 500 index, and that's what that is. And past performance, like we talked about, it doesn't indicate future results. And we do have a lot going on in our world today. We just talked about 4 stocks in the S&P 500 that are way overpriced, and they could be detrimental. If you're an investor of those, I would strongly consider you get a second opinion right now of what to do. I can't say to buy or sell them for your particular situation because I don't know your unique situation, but you do need to have them reviewed. And I think that goes with all your investments. We truly believe in being a proactive manager because here's the deal. During these periods of time, if you would have taken a time, say from 1970 to 1976, did you know the market was flat over that period of time? If you would have went in on the beginning on day one and then got out at the end of day one, you would have made no money.
For 6 years.
16.
What'd you say? 60 to 76?
60 to 76.
That's 16 years.
16 years,
Yeah.
okay. There's a lot of thought that we may end up back there from 2000 to 2016.
Mm-hmm.
It's a question, is history going to repeat itself? But here's the deal. Do you think that there was opportunities in that volatile time for you to buy low and sell high?
Definitely.
Absolutely. Okay. You don't get greedy. You don't get fearful. In fact, you buy fear and you sell greed. That's what Warren Buffett does.
Warren Buffett.
That's right. He's the greatest investor of all times known to us, right? And so if you have a process to be able to do, which we do, we actually can say that every single one of our clients bought into the market in March of 2009 when it hit its low in the 6,000s. Every single one of our clients. Do you think that they would have wanted to do that? Probably not.
No.
It's human thought to say, "Ooh, I don't know. It's scary. It's scary. It's scary out there." And I agree with that. But we have a discipline. We have a process in place to force our disciplines to happen. And that's why they were able to do that. And I think that's so important. You just said it, Stace. Having someone to help you analyze. Right now we are so big on finding value stocks, finding things that may be underpriced a little bit, but good quality stocks to be able to own. Why are we so interested in that? Because a lot of the market is overpriced, and we do feel that way. But there's a lot of the market that's underpriced as well and on sale. And I don't know a woman out there, being a woman, that doesn't like to shop for things on sale. And there's things on
You said it, I didn't.
Yeah, there's things on sale in the market today. So I think that's really, really important to analyze that situation. And, going back to what I mentioned at the first of the show about the gentleman I spoke with this weekend about, he said, I never had good luck in the market. Here's what I've learned about people that invest in and out of the market. They get in for a while when things are going really good. They tend to do that herd mentality. It looks favorable. I think I'll jump in. And then when things get shaky, what do?
They jump out.
They jump out. So is that a way to make money in the markets?
No.
And I want you to remember at the end of the day what the markets actually are. They're companies that you and I use every day as consumers. Toothpaste companies, hairbrush companies, food companies, electronic companies, car companies, gas companies, all kinds of things that we use day in, day out, and we're not going to stop using. In fact, we're probably going to use more of because our population's growing, right? So if that growth is going to occur, if we're sitting here in another 35 years from today and you're 30 years old, what would have been the best what would have been the best decision you made? Would it have been investing in the market, staying in, and letting it ride? Having someone to help you through those emotional times so you didn't panic? And helping you to buy other people's fear? That would be my hope, that it would be. So with that, we've got our trivia, all right? Life planning at Kennedy-financial.com. Email your questions and email your answer to the trivia. The best question of the week this week is going to get 2 free movie tickets. And then our trivia winner today is actually going to get a free analysis done on their stocks. We have this cool software that actually x-rays them. It sees any overlap and gaps that you have so you can know where your risk is right now, okay? So here's our trivia. On Black Monday, back in 1987, the Dow Jones Industrial Average dropped a tremendous amount in one day. Okay, was it A, 53.42%, B, 22.61%, or C, 18.14%? Life planning at Kennedy-financial.com. Remember this. What would Warren do? That's what I want to leave you with today. My name is Angela Robinson with Kennedy Financial Services. God bless America and God bless each of our listeners. We hope you have a wonderful week and enjoy this wonderful spring weather in February.
Yes, ma'am. Gigantic round of applause again for you. What a fantastic show. Thank you so very much. And folks, thank you for joining us. Come back again next time for more Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and again on Saturday morning at 9 o'clock on KATX and KWBY for more Life Planning 101.
Securities and investment advisory services offered through VSR Financial Services Incorporated, a registered investment advisor and member of FINRA SIPC. Kennedy Financial Services is not owned or controlled by VSR Financial Services Incorporated.